In this presentation, I'm going to show you the top things to avoid when investing in cryptocurrency. Investing in cryptocurrency is relatively new that, if careful, investors can consider when they are looking to diversify their assets. However, before you dive in and start investing in cryptocurrency, you should consider these 5 things to avoid when investing, so you can make the smartest decision to meet your needs. Not considering problems of fraud and security. Cryptocurrency is steeped in digital technology, with every transaction, from mining to purchasing and selling, taking place online. This can pose a serious threat, according to regulators, because you can easily fall into the trap of participating in fake exchanges. Do your research and verify the legitimacy of the exchanges and their security processes for all transactions. Avoid high fees. One way that you may be able to avoid the high fees associated with trading cryptocurrencies is by buying and selling through a cryptocurrency wallet. This is something that you can download on your smartphone. While cryptocurrency wallets still have transaction fees, they won't be nearly as high as the fees at an exchange. Avoid buying derivatives. When looking for your next cryptocurrency investment, crypto derivative trading may not be the way to go. Derivatives, including Bitcoin futures, have the potential for more significant losses. While it's impossible to predict the crypto market, you can utilize smart investing practices to save you from making a detrimental investment. Cashing it all in. Diversifying your portfolio can be your guarantee against losing everything. Cryptocurrency has become known for its volatile nature, and its unpredictability regarding returns can either provide you a huge profit or a devastating loss. Selling when emotionally hyped. When trading in digital currencies, it's best to remain level-headed as much as possible. When you continually reevaluate your position, you can determine the best strategy to make. Also, it's best to keep in mind that you don't want to invest more than you can afford to lose when investing in cryptocurrencies. When it comes to investing in cryptocurrency, there are no hard or fast rules that you need to follow. Always take the time to do the research and always think twice before making a decision. Make sure that you are taking the necessary time to make the best choices for your specific situation. Top 4 tips to start trading cryptocurrencies. The world of cryptocurrency is like no other, and when you enter into the world, everything is different. If you're just starting with trading cryptocurrencies, you'll quickly begin to realize just how different things are. Here are some of the top tips to help you begin to trade in cryptocurrency so that you can avoid making some of the more common mistakes. Tip number 1. Don't diversify too quickly. When it comes to investing, you may have been told to never put all your eggs in one basket when it comes to your portfolio. However, in the world of cryptocurrency trading, it is possible to diversify your investments too much and too soon. The reason you want to be careful with diversifying is that the digital currency landscape is still new, and it's impossible to know which cryptocurrencies are legitimate. You need to do your research and choose widely distributed coins that have shown their longevity. Tip number 2. Don't spend a lot of time trading. If you are constantly trading, you can actually end up making less profit. Since the crypto markets are so active, you may think that you will miss what looks like a fantastic profit opportunity, but there will be 5 or 10 more down the line. Spending every waking moment watching the price fluctuations can be exhausting and can lead to mistakes. Tip number 3. Don't panic. The cryptocurrency scene is exceptionally volatile, which can create a ton of uncertainty for the novice trader. This can generate feelings of fear and panic, which is the worst emotional state you can be in when trading. Making decisions based on perceptions of panic can be disastrous, and you should never make decisions based on your alarm and fear. Tip number 4. Don't fall for scams. The natural inclination when investing in cryptocurrencies is to identify a new altcoin with the potential for growth. Invest in it heavily when it's still inexpensive and reap the rewards. However, because the industry is growing so quickly, it means that there are new currencies that might not be a good investment. Being cautious when it comes to investing in new cryptocurrencies will shield you from being involved in a scam, like the pump and dump schemes that are prevalent today. Trading in cryptocurrencies is exciting, exhilarating, and terrifying. To ensure that your trading career doesn't end before it can really get started, follow these tips and avoid the pitfalls of cryptocurrency trading. In this presentation, I'm going to share with you the top investment tips for trading in cryptocurrency. The price of Ethereum and Bitcoin have exploded in recent years, begging the question, is there a sufficient upside potential to start investing in cryptocurrencies? In other words, is it still worth looking into investing in cryptocurrencies, or is it too late? If you aren't very familiar with cryptocurrency but are looking at investing, here are the top tips for trading in cryptocurrency today. Look at real-world usage. Most people are unaware of cryptocurrencies, and if you are considering investing in them, you need to look at real-world usage. According to Statista, only 24% of adults in the U.S. are familiar with the most known cryptocurrency, with only 2% actually using cryptocurrencies and another 25% thinking of using it in the future. This potential increase in use should get investors excited. Cryptocurrency must solve a problem in life. Merely buying cryptocurrencies in hopes that they will deliver an investment return doesn't make a whole lot of sense. For every investor, the goal is to find a way to solve a problem. The more significant the issue that gets resolved, the higher the potential value. Create a portfolio with a limited number of cryptocurrencies. As with every other kind of investment, investors should create a portfolio and actively work on it for the long term. Selectively choosing cryptocurrencies is imperative. You only want to invest in things that you understand and try to keep your emotions under control. Exchanging your cryptocurrencies for money. Never forget that your cryptocurrency can be traded for traditional money. The market is currently in the process of enabling all exchanges, making the previous lock-in risk obsolete. As the market conditions change, make sure that you continue to exchange your crypto for cash. Read the right sources. The internet today lets everybody and their uncle become experts during a hype. Be skeptical when following advice from people and selecting sources to read. The internet only has a handful of bloggers that are worth pursuing when it comes to cryptocurrency. Trading in cryptocurrency can be extremely confusing and risky. Keep these easy tips in mind as you navigate through the complex world of cryptocurrency. Understanding 3 different types of blockchain technology. Cryptocurrencies, like Bitcoin and Ethereum, have become a hot investment over the last several years because of its seemingly get-rich-quick potential. However, before you dive into this new asset class, it's important to understand the 3 types of popular blockchain technology. Public blockchain. This type of blockchain allows anyone in the world to download the data and read the data. This means that anyone is allowed to participate in the consensus process and can write the data or block into the public blockchain. There are numerous public blockchains that anyone can invest in and trade. Bitcoin is one of the more well-known blockchains and was the first peer-to-peer cryptocurrency exchange. Ethereum is another popular blockchain that allows anyone to build smart contracts and decentralized apps. Consortium blockchain. A consortium of members controls a consortium blockchain. Because of this, it has a predefined set of nodes for the users with access to writing the data or block. Members of a consortium blockchain may be participating banks, exporters, importers, ports of sending and receiving countries, custom officials, etc. With this kind of blockchain technology, some of the participants may have write access, and some or all will have read access. Consortium blockchains aren't as fully decentralized as the public blockchain. Private blockchain. All permissions are kept centralized to an organization with private blockchain technology. This is the kind of blockchain that companies used when they wanted to create their own currencies. One of the significant criticisms of private blockchain technology is that it isn't decentralized, but rather nothing more than a distributed database. However, this allows some organizations to have privacy and compliance requirements to implement blockchain, as well as adding values like cryptographic auditioning and known identities to the internal process. Unfortunately, with private blockchain, the beauty and central idea of decentralization and open protocol get lost. Since 2008, when the first cryptocurrency was introduced, blockchain technology has rapidly gained popularity around the world. As the burgeoning technology continues to be ripe with ongoing innovations, it is best to keep an open mind and expect to see new, related technologies continue to emerge. As the world continues to become interconnected, cryptocurrencies will continue to be an attractive proposition for growing markets, making it all the more important to understand the different technologies available to you.